I'm going to lean back now while we shift to talk about taxes. I always struggle when we talk about taxes because I want to know why the tax code is the way it is. And I need to remind myself that taxes are just this bear of a thing that a monster, like a Frankenstein monster that's been created and influenced by tons of different people and interests. And you love talking about taxes.
I wouldn't say I love
No, you
talking
love it.
about
You
taxes.
love talking about taxes. So I am going to lean back a little bit and let Bro lean in a bit more to talk about, all right, what are some of the tax benefits of investing in real estate? Because some of them just make my head spin. I'm like, really? Really? What?
Yeah, well, so it is different than if you go out and buy shares of Amazon. And let's just start with depreciation, first of all.
Yeah, absolutely. So, so a lot of people consider real estate and what they call is tax advantaged income, and that really comes from depreciation. So, you know, when you buy a piece of land, when you buy a property, right, you buy a building and you rent it out to someone, you have cash flow. That's going to be considered rental income. And then you're going to have your operating expenses, things like advertising, mortgage payments, property management fees, anything like that. And then there's one of those expenses, one of those operating expenses called depreciation, which is not a cash expense. So there's no cash that actually goes out of your pocket when you take depreciation, but it can be usually increased through various strategies so that you actually show a loss for tax purposes, despite actually generating positive cash flow. So you might have, just say, for example, you have $10,000 of rental income, $4,000 of real actual cash operating expenses that left your pocket, and then you have say you have a $7,000 depreciation expense. Now you have a net loss of $1,000. So you're paying nothing on that income, but you really pulled in $6,000 and you put into your pocket. So that's kind of what the power of depreciation is. And you can use cost segregation studies to increase your depreciation. And with the Tax Cuts and Jobs Act, they actually came out with something called 100% bonus depreciation that allows you to depreciate property with a class life of less than 20 years. And generally on real estate, anywhere from 20 to 30% of a property can be classified as 5, 7, and 15-year property. So you can depreciate 20 to 30% of that property and take that expenses depreciation in the first year you buy it, which has a major impact on the amount of money and tax you're going to pay over the time you own the property.
Right.
Basically, you're allowed to. It's kind of funny because you're basically saying, I own this asset that I want to increase in value, but I get to take this charge that assumes that it's actually depreciating in value, but it's usually not, really.
Yeah, I mean, it's usually not. For the most part, real estate tends to increase in value. And, there is a dark side to depreciation. It's not all love. There's something called depreciation recapture, which when you sell the property, you have to recapture the amount of depreciation you took, assuming you have a gain, of course, up to 25%. It's a tax of up to 25%. But generally, the thought process behind that is the time value of money.
Right.
You'd rather take the depreciation today, have the tax-free cash flow so you could reinvest it, put it back into your business, and then pay the taxes later on than to worry about, if I have, and by the way, you can't not take depreciation and avoid that. Some people say, well, what if I just don't take depreciation? Do I have to pay that tax? The IRS will assume that you did take the depreciation and charge you that tax anyway. So you're better off taking it. There's no way to avoid it. And, there are ways to avoid that depreciation and recapture tax. And I think we'll talk about that in a little bit as well.
Right. So that's basically getting a tax break along the way. But then there's the tax break you can get when you sell the property, otherwise known as 1031 exchanges. Why don't you talk a little bit about that? Yeah.
So when you sell a property, you're going to have a capital gain, and part of that capital
hopefully you'll have a capital gain.
Yeah. I mean, assuming you're investing the right way, you're going to have a capital gain, right? And you're going to have part of that capital gain is going to be depreciation recapture. Now, what a 1031 exchange allows you to do is defer that capital gain and the depreciation recapture by purchasing another property. So what you have is you have 180 days from the day you sell your original property to roll over the entire sales proceeds, so both the capital gain and your original principal, into another deal. This is normally called trading up. So let's just say you have a property that you bought for $100,000. 10 years passes and now it's worth $150,000. And you have a $50,000 capital gain. Break it up in between capital gain and depreciation and recapture however you want. You're still gonna have to pay tax on that $50,000. So when you pay tax on that $50,000 of capital gains, you're gonna have less money you can reinvest. So what a 1031 allows you to do is invest that entire amount. So you're not paying the taxes today, and you can purchase a larger property. And you could continually purchase larger and larger properties and continue to use the 1031 exchange pretty much forever. And if you really wanted to, and it's just got to be honest, it's easier said than done. You can eventually leave the property to your heirs, and they'll receive that property at the fair market value on the date of your death, eliminating all of this capital gains and depreciation recapture that you should have paid during your lifetime. So, in theory, you can just keep purchasing larger and larger properties, making more and more cash flow, but never actually paying any taxes on that property.
So crazy to me.
Yeah,
it's just crazy to me. It's like, this is one of the reminders of like how it's easier to get richer when you're already rich. Like, if you're already wealthy, then there's all these ways for you to just easily make more.
Well, I gotta say something on that too. So, these days I feel like, the internet, Google, podcasts like this, there's a lot of ways to access information. And as long as you're willing to put in the work and, do the research and kind of pull things together, I always like my motto is going to be figure it out, right? As long as you're willing to figure it out, you're going to be able to put a lot of things together, and you can use these same strategies that, the quote unquote rich are using. There's no one stopping you from using it. It's just in the past, there wasn't as much access to this information.
Oh, sure. You'd have to like join the country club. Like you'd have to be on the links to learn about real estate deals.
Yeah. You'd have to be paying attorneys and tax accountants a ton of money to figure this stuff out. But today, it's all there.
Yeah.
It's all there for you.
Yeah.
Now, you mentioned opportunity funds.
Yeah.
So this is a very new thing. I'm not going to even try to describe it. I'm going to leave it to you because it is so new. But it is another way to defer and maybe even eliminate some of your capital gains. And it doesn't have to start with real estate. It could be you want to sell some shares of your Amazon. You have a capital gain. Here's a way to at least defer some of that.
Yes. So
can you define for us what an opportunity fund is?
Absolutely. So so before we talk about an opportunity fund, you have to understand what an opportunity zone is. So an opportunity zone, there's 87,000 opportunity zones across the United States, and they are low-income communities that were designated by the state governors as opportunity zones and then approved by Treasury. An opportunity fund is the investment vehicle that you can invest in an opportunity zone. And for investing in these opportunity zones, through this opportunity fund, you have these tax incentives. The way the opportunity funds work is you can defer the capital gains tax on any capital asset. That's usually stocks, bonds, mutual funds, real estate, things like that. If you're not sure, you could always ask your CPA; they can let you know. But basically, what you can do is you can roll it into an opportunity fund within 180 days of sale. Very similar to a 1031 exchange there, but the difference there is you only have to roll over the capital gain. So you could take the principal back that you invested, put in your pocket, do whatever you want with it, and then if you hold that capital gain in the fund for 5 years, you're going to receive a 10% stepped up basis in that gain. So let's just say you have $100,000 capital gain, and in 5 years you receive the 10% step up. You're only going to pay tax on $90,000 of that capital gain. If you hold it for another 2 years, for a total of 7 years, you're going to only pay. It's going to step up another 5% for a total of 15%, and you'll only pay tax on $85,000 of that gain. Now, if you hold that investment in the fund for 10 years, your investment in the actual fund itself will be tax exempt. So let's just say that $100,000 you put into the fund, 10 years from now, it's now worth $150,000. That $50,000 capital gain is completely exempt from tax. Now, this is a longer term play. You have to keep your money in there for at least 5 years to see any benefit of it. I think there's over $7 trillion or something, some crazy number of appreciated gains in the United States. So all of those appreciated gains are technically eligible for opportunity funds. And I think the background behind this is they want to take those appreciated assets and move them into low-income communities that need renovation and raise the status of those communities, and opportunity zones, opportunity funds are the way to do that.
So this isn't a situation like a mutual fund. Like you don't go to Fidelity and say, I want your version of the opportunity fund, right?
Yeah, no, I mean, I think you're going to see, because of the requirements to have an opportunity fund, you have to either substantially improve these assets, which means doubling the property's basis. Essentially, it's the building's basis, but just think about it, I guess, for this purpose, as the purchase price. You have to add as much as the purchase price, basically, and capital improvement. So it's substantial, or you have to develop the property from the ground up. So for individuals, and then you have to hold it for 10 years, right? So for individuals, this might be a hurdle, but I think you're going to see more institutional level people doing it. You're going to see more of the crowdfunding sites doing it. Will someone like a Fidelity do it? I don't know. I wouldn't think so. I think you're more or less going to see. I mean, I think Goldman Sachs announced something, but you're going to see more of the professional side probably on crowdfunding.